Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really happy to have with me once again Frank Holmes. Frank is a highly experienced financial professional and one who is a very pragmatic investor. Frank is unusual, in my view anyway, among many mainstream financial analysts in that he understands the importance of having a negatively correlated asset like gold as an important portfolio strategy. Now, he's not an all-in gold bug by any means, but Frank is a person who really does his homework and comes up with new ideas about how to invest and always learning new tricks, which makes him very, very valuable and makes his group of funds at the U.S. Global umbrella of funds to be very, very important. So we're really pleased to have you with us again. Thanks for joining me today, Frank.
It's great to be here. Long time no chat.
Yeah, it's been a while. Before I get started, I do want to ask you, I understand that you and one of your colleagues there, Ralph Aldis, was awarded Best America's Based Fund Manager. Can you talk a little bit about that? That was by the Mining Journal, I believe.
Yes, thank you very much. It was recognized. I think they used Morningstar as a system to look at stocks and stock pickers, etc. And I think IBD had caught a story on it that we're outperforming the GDX and GDXJ, and how did we double over the past 3 years? And they were still negative. So he was looking at it that way. So from that end, the biggest thing I share with you, Jay, is being a rigorous analyst. And in the previous cycle, which we received awards for best mining fund group in the world back in 06 and 07, in those periods. And one of the things we did back then, we were leaders in 5-year warrants. And we would price a new financing, and we always went for the optionality, and they wanted our order to be the lead order for financing. Then it had to have warrants at this strike price in particular. So we had a lot of quant modeling done on the value of a warrant and getting listed. And that gave us this massive outer performance during that 2001 to 2008 cycle. Mm-hmm. The cycle's changed since 2008, and what you've seen is what came out after them was the GDXJ, which seems to be all the mid-cap and some of the small-cap producers, and it becomes self-fulfilling because money only goes into the ETF, and they only buy their basket of names, which they change once a quarter. And it grew from nothing to, I think its first week was $400 million. It came out in 2009, I think. Mm-hmm. And it's now billions of dollars of money flows. So I think what we recognize is that you had to look at what were their factors and how has the market changed. And the big factor is, I guess I keep using this word factor, is because it's called factors that they look at, and it's the quant world. And the quant world, we're so consumed with algorithms for high-frequency trading, but really, Jay, it's high-frequency research. Mm-hmm. The data mining which is expected from an energy company or a mining company, such as you've seen Robert Friedland's presentations of 3D graphics and where the drill holes are, and remember what Rob McEwen did years ago of putting all of his data out on the public, and they're using 3D graphics, and there's $1 million contest to find the rich deposit. That concept of using data for picking a resource, mining a resource, or looking for a resource, etc., is now entered where these machines can quickly look through every gold stock sell broker analyst, and in one day can rank them all, who is more accurate and who can move markets.
Rank the analyst, you mean? You rank the analyst. I see.
And they rank the CEOs. They know the CEO has gone from firm A to B, and they rank them on certain factors. And the factors are, most important is how they protect the value per share. So the revenue per share growth, 1 quarter over 4 quarters. The cash flow return on invested capital, which is an important ratio that's used in the capital markets to look who's better at generating cash flow returns on invested capital deployed. They look at these, and they use up many different types of factors. But I wrote about a piece several months ago, and I said the lowest G&A to revenue, the lowest. Mm-hmm. So I took the 10 lowest stocks in January, and I bought them, and then I rebalanced them in March and rebalanced them in June, And year to date, they're up 200%. The GDX is only up 70%.
Mm-hmm. Wow, that's
but
pretty remarkable. But a
mutual fund investor, I have to have 20, at least minimum 20 investments, so I can't have a concentrated portfolio like that. But what it's telling you is that it's the factor, one of the factors that the quants look at. That's why those stocks went up.
Mm-hmm. Yeah,
so when I go around and visit these sell analysts, I went around into Toronto, Vancouver, and New York, and went to many of the different firms and said, so who's buying these gold stocks? Who are you getting in front of? Only one firm was able to answer me, and that was CIBC. And CIBC was the one that was able to say that it was quant funds. And quant funds, they don't care about seeing a gold analyst. The macro funds do. The Bridgewaters, the George Soros, they will listen to a gold analyst. And they will want to get color and insight as they take a position. But the quants don't care. They're using all this data mining themselves and looking for one of the 70 factors, and then they sort of put together what they think is a magic sauce, and they buy those stocks. And that's what's really important. So in winning this award, we're very sensitive of knowing, okay, well, what are the factors that are important for getting alpha? And so we used a series of different types of factors that would tilt our portfolio. And that was one key element. And the other one I've mentioned and I've written about many times. Oh, Jay, the other one is I wrote a piece a couple of weeks ago. Your subscribers go to usfunds.com. You can see these articles. I highlighted cash flow return on invested capital as a factor. And once again, it was almost 2 times what the GDX was.
Interesting.
If I just took a concentrated portfolio.
So you're always looking for different factors, perhaps, though they may change from time to time. Yeah.
Yes, I'm looking at factors that drive the attraction where people have confidence in, and so the idea of your future production, your future reserves, etc. There have been so many delays and disappointments from poor management or from poor government policies that derail or destabilize or defer this increase in production, and so therefore they're going for momentum rather than saying what the company's future looks like, because they believe that the odds favor they're not going to deliver what the expectations are. So we did this, and it's been insightful, it's been useful, and it's recognizing that. So a lot of these CEOs is going to be the biggest part of corporate governance. It is if you're not able to show against the benchmarks how you're doing, then you're not going to perform. Now, one of the things we noticed was Newmont. Newmont's the only pure gold producer in the S&P 500, or the 500 stocks, and its free cash flow went from negative to positive in the past year, and so therefore, it grew faster than the S&P 500. So the quants all of a sudden start buying Newmont because it shows up as a turn in its cash flow substantially greater than the overall S&P 500. And that's what they do. They do this relative comparative analysis. We've also done another way of looking at factors is where royalty companies bless, when they basically bless a project that they've done all their own work on and they put money into the company. That gives us a certain degree of confidence because they're willing also to deploy their capital. And many of those junior stocks were the best performing gold stocks last year in the TSE. In the top 10 best mid-cap gold producers, 7 out of the 10 had royalties from Franco-Nevada.
Wow.
So it's you do your own homework, and then you get an overlay. So the fact that they do get a finding from Franco-Nevada is like the good housekeeping seal. This is a good Betty Crocker cake mix.
Well, it seems to me, though, you're talking momentum, so in a way what you're trying to determine is who else is putting their money in there, or where is the money flow going to go, more than whether these companies are successful longer term. So I'd be interested in knowing longer term, Frank, whether these quants are going to pick the right companies for the long term, or don't they care about long term? It's all about short-term profits.
No, they don't care about long term. They
don't, and they're agnostic, and they could care less about gold and gold, the things that gold bugs like me care about. They could care less. I mean, it doesn't matter. It's gold is the industry that's making money now, so we're in there, right? We're in the gold mining sector. Right. Otherwise, we're out. we're into something else.
But you and I can learn from them because they will quickly access something that we don't know why, and it begs us that we better find out why.
Sure.
And if all of a sudden that the relative strength of a gold stock starts acting better, and we don't know why, then we have to figure out what were they looking at. I think that's the other part of that coin that's positive, and we're looking at what that quant world's doing. Another thing is social media. A classic was a service that looks at tweets, and they were looking at tweets, and a hedge fund was long Chipotle. And he saw the tweets were coming in negative, that people were getting sick 3 weeks before it came that they had a press release that Chipotle had problems because they were tracking that. So the data mining is very different. It's just recognizing that and how to use it to your advantage.
Sure.
And I think that money manager that says, I want to read Barron's Saturday morning, drink my Starbucks coffee, and pick stocks, they're history.
Yeah, I can understand that very well. That's Frank. Mention the name of. You got a couple of gold funds, just for the benefit of our listeners who may not be familiar. Mention a couple of them, and maybe the difference between the two.
I think the one that's in particular buys in the junior space, which you have a strong following, is World Precious Minerals, WMPX, and because it's 15% allocated towards junior space. And so I think that that's an important part of looking at that industry is how we look at the junior mining. And we look at junior mining. So when we look at junior mining, we look at a lot of metrics such as grade and reserves per share. So we saw it from the meltdown from 2011 peak in gold at 1900 down to last year, that decline. A lot of the junior stocks that didn't rebound were the ones that destroyed their value on a per share basis. They kept doing financings and financings. Yes. So you end up having less gold or less copper per share.
Right.
And they didn't experience the surge and the rebound. The ones that did, they exploded in this year to date. They've had huge 300-400% moves, and they've been able to now do financing at much better prices, so it's not dilutive. So it's recognizing that these factors you have to look at are just different. Let me give you another one, Jay, about this cash flow return on invested capital. Who's did so well there? The Australians, and some of our Australian stocks have done. You meet the CEO, and they're former mining operators. And when they bought when Barrick sold assets in Australia, and they bought them, or Newmont sold them, and they bought them because they were both divesting of assets. They knew how to squeeze $30 million in free cash flow out of the system within a quarter. $30 million. Yeah. And so some of these stocks in our portfolio are up 800% in the past 5 years.
Yeah, that's fantastic. Well, the main question then, Frank, though, is the gold bull market over? There's a lot of concerns there. A lot of the junior mining executives that I talk to have seen this last little correction. I think it's nothing more than a correction, but they're concerned it could be something more. You wrote an article, your last weekly missive, and I might just mention, I believe, Frank, that your weekly newsletter is available to people who simply they can put their name on a list and get your. Yep. Yeah, it's a wonderful letter.
Subscribe.
I can tell you that last week a recent one was No Love for Gold was an article that was your most recent one, but you always a very interesting newsletter that comes out every week, and it's free of charge, right, Frank? And so people can just go there and put their name on the list. So. The last one is No Love for Gold was the last letter last Friday. You put this out on the weekend, I guess, and every weekend. So what are your thoughts now for gold? I mean, aside from the quants, but maybe you look at quant.
I was trying to make a point that we had China was closed, and China is very important. Gold is the fourth most liquid asset class in the world. B, China has gone from price taker to price maker, and the fact that the Shanghai market was down, and they're the first and second most major player. And in the love trade, they're the number 1 and 2 with India. So it's a Chindia effect. And when China shuts down like that, and it had a significant volume factor. But I'm going to relate this to something else. I think it's really important. You hear this efficient frontier and what it means and what they call, the quants call the market's efficient. Well, actually, when you read the material, the market is only efficient when you have piranhas. That's what they call it. And Adam Smith called it the invisible hand.
Sure.
And there's an arbitrage that takes place. And so I think a lot of these high-frequency research are part of that arbitrage, that they are the piranhas of information. And it's the same thing looking at the juniors. Like, do I have more insight than someone else? Then I will all of a sudden have first-mover advantage, and I become that piranha that then all of a sudden the capital markets look efficient.
Yeah.
So what I was trying to share with people is that the market was inefficient because two things happened. One was when the negative news came out on Brexit, by Holland, the president of France, making his knock like his country likes to knock all great American corporations, from Apple to Netflix, etc. That they made this negative statement towards the British. At the same time, when there was other news, economic data points that came out when the U.S. capital markets weren't open, and neither in a sort of a quiet period with the UK. And guess what? The Brexit, the currency fell 6%. When America opened up, all of a sudden, the buying started coming back into the Brexit. Well, we had that experience with gold, too, with China not being there, and that's what I was trying to highlight last week.
Yeah, well, that certainly makes sense. Another firm in New York, a mutual fund firm, was suggesting it might have been the paper trade. By the way, this guy Andrew Maguire, I know, is in agreement with your view there on the China issue, Frank. But another firm here in New York that is a mutual fund firm suggested that maybe it had more to do with paper flows. It noted that there was a net inflow of money into GLD, or one of the ETFs, the bullion ETFs, and that normally until that point in time, until just recently, it had really correlated very well. In other words, money going into the ETF and gold prices rose, but not this time. So do you think there could be anything to that? Paper trade?
Yeah, I think
possibly,
there's no doubt, and in particular when it's a quiet period.
Yeah.
I think it's just recognizing that if you don't have the normal liquidity, the capital markets aren't fluid and open, then you can get this type of volatility. We notice it all the time. You know, it's just a factor of trying to quickly, what's news, what's relevant, and guys play games with it. There's no doubt, and it's just part of the overall ecology of the capital markets. It really is.
Frank,
so go ahead.
Yeah, go ahead. No, you go ahead. Finish your thought.
No, I think it's unfortunate if you just put a trade on and they whack it down and do this type of shenanigans. But we're not getting away long term, Jay, from trillions and trillions of dollars of debt and pensions that are unfunded. And what they're doing in Chicago, I wrote about 3 weeks ago, taxing people to oblivion for government pensions and workers. So we'll all become enslaved to government union pensions. And how far does that go? I think that long term, this is probably the important part for gold.
Yeah, I have no doubt about that. Well, I wanted to ask you, because you mentioned in your last weekly, you talked about the IMF's warnings about global debt, and if nations don't delever pretty soon, there are going to be some grave consequences. But I'm thinking, well, even if we do delever, there's going to be some grave consequences, Frank. And I mean, it seems any way you look at it, we're in big trouble.
Yeah, we are. And if we're balanced, we'll be okay. And we're smart about being balanced, like owning some gold bullion and owning silver coins and having that diversification. And, one of the things is I've been a big student of is the tax-free munis. And we have a top-performing muni market. Well, they're not going to come and sort of confiscate tax-free munis. They'll confiscate other things. And so it's just recognizing, what do governments do when they panic and do things? So I think that there's ways to diversify, and I think that's what's really important for investors to have and to rebalance, like I've said about gold. You have a 10% weighting in gold, and you rebalance every quarter, and it's amazing how it helps your performance.
Well, it indeed it does, Frank, and I can't get over the time when you were on CNBC and the mean-spirited host there was giving you a hard time for rebalancing. How could you dare put people into gold, Frank, when all you've done is lost a lot of money over the last couple of years? I mean, you ought to go to jail, Frank, for your recommending people buy gold. When it's a losing proposition, well, not so much, and I don't see that guy coming on and patting you on the back now for rebalancing. So your strategy has worked very well, Frank, and I think you are to be commended for it and for sticking with it. So we have some real issues. Massive paper market selling. I wonder though, with another minute left, interest rates rising now, Frank. Is this a function of the markets are saying we need higher returns, or is it really the Federal Reserve that is driving rates higher?
No, it's the Federal Reserve. The Federal Reserve is driving it, no doubt. That's what I think is important to recognize. But I wouldn't get too caught up with it. Any negative news, and all of a sudden they'll kick it back down. My big threat is I don't think so. They're going to raise rates. If they happen, it'll be negative for many reasons because we're just living with too many regulations in every part of our life. Yeah. And I think that's the whole reason for Brexit. Taxation and regulation without representation led to a revolution in America, and Absolutely. It led to Brexits.
Absolutely. Well, Frank, we're out of time. We're going to have to leave it go at that. So much more to talk about. We'll have to have you back again sometime soon. It was a pleasure chatting with you. Thanks for being with us today. And again, we'll do it sometime again soon. Thanks very much.
Thank you.